Okay, good morning, everyone, and welcome to our VA Loan Assumptions webinar. I am Beverly Franklin, Director of Marketing and Communications at MBH Settlement Group. With over 1 million veterans in Virginia, Maryland, and DC, understanding VA loans and VA loan assumptions is so important. Together, District Title, the Federal Savings Bank, and MBH Settlement Group will be guiding you through this seemingly complex topic and break it down. At the end of this session, you will have a better understanding of VA loan assumptions, enabling you to expand your current client base and better serve your veteran and military clients. Now for the introduction of our presenters. Joining us from District Title is Steve Sushner. Steve is president and founder of District Title, MBH's affiliate, and is admitted to practice law before the DC and Maryland Courts of Appeal. District Title, for the last 20 years, Steve has been dedicated to building District Title, which is a top-ranked title company by the Washington Business Journal. MBH and District Title have completed over 250,000 closings, have 20 offices throughout Virginia, Maryland, and DC, and have a team of almost 24 attorneys. Our next presenter is David Piatek. David is loan officer and senior vice president for the Federal Savings Bank, where he works with buyers across the country, guiding them to becoming homeowners. David has spent the last 6 years teaching a variety of courses for NAR and developing CE for the nationwide real estate community. Recently returning home from an overseas deployment, David has served in the Army National Guard for 12 years and continues to serve today. Thank you everyone for joining us, and let's get started.
Thank you, Beverly, for the introduction. Welcome everyone. Just a couple of housekeeping items. We will be recording this session, which we'll send out to everyone in the next day or two. If you guys have any questions, I know that there was a couple comments that chat was not enabled. It is enabled now, so you'll be able to ask any questions through that. And then at the end of the presentation, we'll also open it up for everyone to be able to ask questions. So you'll be able to unmute yourself and ask. So without further ado, when we talk about VA assumptions and how they work, right, it's kind of confusing for realtors. Let me get the presentation up here. Perfect. All right, so you guys will also have all our contact information as we go through this. But when we talk about the VA assumption itself, right, there's a lot of information that's online. Like I researched a lot of it before doing this presentation, and the information is misleading or it's just flat out incorrect. The information that we get for today's presentation is directly from the VA handbook, which I'm going to provide that resource to you, and also talking with the VA itself. Now, the agenda that we have presented for everyone today is going to be, what is a VA home loan assumption? Who can assume a VA home loan? Because there's also a lot of misconception around that. Processing loan assumptions. We're going to talk about divorce situations when it comes to the assumption. Now, some of this stuff I also learned myself recently, so you guys be able to get that advantage as well. We're going to talk about working with sellers. We're going to talk about portfolio second mortgages with VA assumptions. And then we're going to give you an example of what that looks like. Now, the power of the assumption itself, right? It's important to really get an idea of how much an assumption can save someone. Now, providing all terms are going to be the same, right? So $500,000 over 30 years. At, first example is the assumption at 2.25% rate for a military member. And the next one is at where the current market rate is. Now, please note that I do not have the APRs in here, right? This is just for the actual assumption itself that we look at. So in this example alone, it saves a potential buyer, assuming at that 2.25% interest rate versus where the market is, about $450,000 in just interest alone. So, Steve and I were talking about this a couple of weeks ago, is that in theory, right, a property that might be the same value as another property is actually worth more just because of the amount of interest you would save, right? That's real money on a transaction. So keep that in mind. And then also when we go over the example at the end, you guys will also be able to see the differences with using second mortgages on these products. Now, when it comes to what is an actual VA assumption, right? That is actually where a military member has the ability to transfer their loan terms to a potential buyer. Now, that it's going to include, the assumption is the actual balance and the term at the time of closing, right? So when Steve goes in and does a closing on, let's say today on December 7th, and the balance is $532,555.32, that's the actual assumption that will happen on the CD. And then the other piece to that as well is that if somebody has a 30-year mortgage and they've paid off, let's say 13 months of that mortgage, then they're actually taking over a loan that has 347 months left on that payment, right? So in the prior example, it's actually a much bigger savings than what's presented when you compare the numbers themselves. One thing that's also important to note on these transactions is that there's no appraisal or termite inspection required per the VA. Now, Steve has done these closings. This is why we're doing this together. Because the property is already, they're assuming the current liability of that mortgage. Now, if there's a second mortgage required, then yes, there might be an additional appraisal that's required and or termite inspection, but per the VA, that is not required. It's still a regular transaction. You still need to have a sales contract. Steve, if you could talk to what makes it different on a sales contract in an assumption per se versus a regular transaction?
So, of course, the form of the contract is going to depend on the exact geographic area that the parties are working out of. But for all intents and purposes, there's no real difference in the contract. The typical contract, of course, has the financing, has the language we insert what the financing terms are going to be. In the assumption, there's typically, and in most of the local real estate agent contracts, there's an alternative section. It's often labeled a B section, I think, in the G-car contract. There's other variations in some of the other contracts that are in the area. And it's been there for decades, and most agents have seen them for decades. And we all promptly either ignore it, don't fill it out, or cross it out. But there's really no major difference. It's just you are simply choosing that it is going to be assumed rather than it is going to be obtaining finance. Now, there are differences in the fact that you are assuming the loan rather than getting your own financing. The biggest one being, subject to some caveats David may give you about some second mortgages later, you don't need an appraisal. You don't need a termite inspection on it. So those can be items you automatically can strike out or not include in your original contract. But otherwise, it's the exact same stuff we've been doing. You're just using a slightly different section.
Yeah, perfect. Thank you for that. Also with this, the transfer taxes are still going to be applicable to this, right? You still have to pay title fees, real estate commission if it's applicable, and then still the deed gets recorded at closing. Processing times are going to be typically longer, right? 30 days. I think somebody made a comment in the chat, and just bear with us as well, folks. It's just that with the amount of people we have in here, we might be a little bit delayed in getting back to you, which you can also message us offline. Someone mentioned that it took 3 months to close on a VA assumption, right? This is why it's also very lender specific. Just to kind of give you a caveat on that as well, it's folks like me can't do the actual assumption. It's the servicer that's going to be handling the entire transaction, which we're going to go over here shortly. Now, buyer still has to pay the equity, if any, to the buyer, right? So that could be either cash, money market, retirement. They can use that money to be able to do that. The VA does allow for second mortgages. Now, I was talking with someone yesterday, right, where they have a couple lenders that think that the VA doesn't allow for second mortgages, but they actually do allow for them. Now, that can happen in a couple different ways. You could do a fixed second HELOC, which is servicer specific. And I know that from my knowledge, no bank in the industry, no bank does these. And Steve, you can vouch that too. Like we haven't come across any. So we're going to talk about that towards the end, because we got, as of 2 days ago, got approval to do an actual second mortgage on these VA assumptions. But there's also some caveats to that. Now, when it comes to the seller's second, and so the couple of questions are coming in here that what is, if let's say someone's VA assumption is for, I'm going to use a $500,000 example, right? And the sell price is $700,000. That difference, right? There's no appraisals required because it falls onto the consumer that's assuming that mortgage to do their due diligence for that process. Okay. If there's a difference of that, and let's say you are getting a second mortgage, then the second mortgage lender will require an appraisal for that property. They probably won't require a termite inspection because those same rules don't apply, right? The thing is you have two sets of rules for this. You have the VA rules on a regular transaction for the assumption itself. And then you have the second mortgage, which is either a seller's second mortgage, which Steve will talk about in a minute, or it's like a bank specific product, right? But the caveat to that is that the servicer that the person is getting the assumption from might have their own overlays for either debt to income requirements or credit requirements for that assumption. Let's see if you can talk about second mortgages and how the sellers can finance those.
Sure. So I think it's important to understand that we're really in a mindset, right? That people typically put down 20% on the property. They put down 15%, 10%, 5%, 3.5%. That's like ingrained in everyone's mind. But a VA loan or an assumption is not necessarily going to work like that. So you really have to consider what is the value of the property now in comparison to what is the balance on the mortgage. So just to keep numbers relatively round, let's stick with 500,000. So if the purchase price is 500,000 and the balance on the existing VA loan is 470,000, then the buyer has to bring $30,000 to the table. If the balance is on that mortgage is 400,000, they have to bring $100,000 to the table. And same thing, if it's 300,000, they have to bring 200,000 to the table. But how they bring that money can come in numerous different formats. So they can bring cash just like they normally would. Now, in the example of 300,000, is the outstanding balance. Now they're bringing 40% down. And some of our buyers are perfectly capable of, we're planning on doing that anyway. But not all of our buyers. A lot of our buyers aren't in a position to put down such a large amount. Many of them aren't even in a position to put down the 20% down that they may have normally, that would be more traditional in a conventional loan. So they can do that in several different ways. And David's going to talk specifically because his bank has a very beneficial program where they will actually lend you second mortgage money. And it's been a while since we've seen these really big in the market, particularly with larger dollar amounts. You're going to pay second mortgage money rates for it, but David's going to show you why that is super advantageous, even to pay higher interest rates on the second mortgage. I'll give you some very specific examples. But it's not the only way it can be done, right? So first option is the buyer just brings the extra cash. The second, and depending on the amount of that cash, that may be the most common. The second option is to link with a lender that has a second mortgage program for VA loans. David's going to talk more about that. And right now, there's not a whole lot of it. So you're sort of getting in on the ground floor here. David's like way out on ahead of this and set some stuff up with his own particular bank. But there is a third option, which is going to seem very unusual and rare and so forth to everyone who hasn't been doing this job for more than about 35 years. And it's one of the things I want to remind people. So up until the early 1983, 1984, assumptions were extremely common. In fact, they were really popular between late 70s and mid 80s because of the way interest rates were. Pretty much similar thing is where we are now, where interest rates spiked, although they spiked drastically higher back then. But same concept. So instead, what can happen? And if you are an agent that works on the listing side, you need to pay particular attention. The seller can offer second mortgage money. And we're going to see it come back in force. And we need to educate our sellers on what this means. So the seller can act as the bank lending the second mortgage money. So using the same example we had before, $500,000 house, balance on the mortgage is $350,000. The buyers were prepared to bring 20% to the table, that's $400,000. There's a $50,000 gap. The seller can lend them that second mortgage, that $50,000, and close it without involving a bank. What the terms are to that seller, they're entirely variable. Obviously, you need a good title company with good attorneys involved. Just saying we have 19 attorneys over here, but a good title company with attorneys involved can help draft that particular paperwork for you. And the seller, in regards, becomes the mortgage company for that. Becomes the mortgage company, becomes the bank for that second mortgage. And they can, depending on the deal, they can get rates that are comparable to what a second mortgage bank might get. They might get lower rates, they might get higher rates, all in the particulars of the exact transaction. I saw a question in there. Yes, it absolutely is a recorded second mortgage in the land records. They have all the same provisions, all the same priorities. And again, it's something historically we have not done in the last 35 years. But there's nothing wrong with it. We need to educate our sellers on the options for it. And when you see what the rates are on those second mortgages, they can become very advantageous for sellers. I might get too long-winded on this. I'm happy to take a bunch of questions at the end regarding it. But I do want to point out that it doesn't have to be a 30-year commitment on that second mortgage either. It can be structured in a whole bunch of different ways. It can be a fixed interest rate with a balloon at the end of it, meaning after 1 year, 3 years, 5 years, 7 years, 10 years, it gets paid off. On the example I had before of the $50,000, that's not a huge amount of money. That $50,000 can be condensed not into a 30-year mortgage, but maybe into a 15 or a 10 or a 7 or a 5 or whatever it is that makes sense with the particular deals of the transaction. But I think as David goes into the second mortgage, you can start to get an idea of why this can actually be an advantage to the seller.
Yep. Thank you, Steve, on that. And so I'll just answer a couple of questions that folks had in the chat itself. Is yes, the seller does have to allow for the second to happen because they will require the loan term or loan commitment for the second mortgage that they'll factor into their own calculations for debt to income ratios, or if they look at residual income, right? I spoke to the VA this morning about this because this was a question that I had was not all lenders underwrite to the VA standards. They have their own overlays. Now, the VA did confirm with their assumption department that lenders can allow for their own overlays that potentially could restrict a buyer from being able to assume the loan, even though from the VA side they qualify, but from the lender's restrictions they may not. So that's something that you have to be very careful about. Yes, the seminar is being recorded, so you guys will be able to get a copy of this. Someone asked, will the seller have to take a second? If the seller takes a second mortgage, will they be able to buy another property? Yes. So the first mortgage will get assumed by the incoming person, which we're going to break down in the next slide. So the VA benefits, the entitlement of the military member will be freed up if another military member is coming in for that property. Okay. And then basically what they won't get is they won't get the entire second mortgage if they do a seller second, because all that equity is going to be locked into the property. So keep that in mind. And then a couple of questions are coming in about who can assume that. So we're going to talk about that in a minute. An example of an overlay, right, would be debt to income ratios. VAs look at residual income, and they don't look at debt to income ratios per se, right? Manual underwrites do if someone wants to get technical, but from the general side of things, they don't. So the VA or the servicer, right? They might not do mortgages, but they'll do servicing. They might just be only servicers. And they might say, well, we're going to cap out at 45% debt to income ratio, even though the VA can get closer more to 70, really depending on the financial situation of someone. So that'd be an example of an overlay on that, or just having an overlay along with that on the second mortgage on what they allow up to, let's say, as far as loan to value, right? They might say, well, we won't allow a second to go up to 100% financing, right? They just might not allow that. So those are things that you need to know, which we're going to talk about here in a minute. Another big question is how many times can you transfer a loan assumption again? So if I get an assumption, can someone then come take that assumption from me? And the answer to that is yes, it's unlimited times. Now, one thing that I would want to point out, and I talked to Steve we talked about this, at some point, the assumption won't make sense, right? If your current balance, $700,000 purchase, your current balance is at $500,000, in 7 to 8 years, if that balance is 200,000, are you going to take that 2.25 and a 200,000, and then you have to put down, let's say a property is worth $1 million, $800,000 down to get that? At some point, it just won't make sense to do that. So kind of keep that in mind. That's why we think, at least now for the next couple years, this is going to be extremely hot, especially if you know how to do these. It's going to be a killer. Now, when we talk about processing loan assumptions, we're going to first talk about who can assume the VA home loan, which a lot of people had questions on. Anyone. So that's non-military and military. Now, there's some caveats to this that you have to be able to explain to your buyers and sellers when you're going through this, because the little information is also very dangerous. Non-military can buy this, but it does lock in the seller's benefits into that property. Now, the non-military member can be purchased this property as a primary, a second home, or as an investment. So keep that in mind, right? But it does lock in the seller's VA home loan benefits. I'm not sure why people would do these. I've never come across a veteran that would be like, yeah, I'm just going to give up all my benefits. The only way that that veteran will get that benefits back if they're locked into the property is that it will be when they sell that property, or if they pay off the property, then they're able to do that. So something to keep in mind. Now, if it comes to the military, they need to have sufficient entitlement. It does have to be a primary residence. One of the questions that folks had was, if somebody doesn't have enough entitlement to assume, let's say the $500,000 mortgage, but let's say they have enough to assume $450,000 of it, and then they could do a down payment for the difference, right? Because just a reminder, if you don't have a VA home loan, there is no limit as long as you're eligible and qualified up to there's no limit. You want to buy a $4 million place with 100% financing, you can do that. But if you have a VA loan and you're keeping that VA home loan, then what's going to happen is you then are going to be subject to the old rules, and then there's going to be caps on your entitlement and what you can do. So just make sure they have enough entitlement to do that. If they are short entitlement, to my knowledge, they cannot put a difference down because they have to assume the balance of the current mortgage. So I guess that's kind of and that's something we can get clarity for by talking with the VA and let you guys know. But they specifically said it has to be the balance at the time of closing. It cannot be a difference. So you're not putting a down payment on that money when you're purchasing the property. Now, in order for the military member to be able to swap their benefits, they need to submit a substitution of entitlement. This is extremely important because it swaps out the benefits from military to military. It is not required, so it can be missed at closing. And this is the crazy part. It's completed after the assumption and the release of liability. Right? There's two things you really need to have in mind. The VA form 26-8106, they love forms, needs to be completed, and you need to double check that the veteran has enough entitlement in order to make this work. Again, if they're doing like if they have multiple VA home loans, which they can have, you need to have that reviewed by either yourself, if you do a lot of VA loans, or just have a lender take a look at it. But this is the most important part, the substitution of entitlement. Otherwise, the benefits get locked in, even if it's a mill to mill. Now, a situation come up where a military member might be assuming someone else's property and they don't care if their benefits are locked into the property or not. Then the military member could be subject to the non-military parameters because they're not doing they're not using their VA benefits to make this happen, right? So that'd be completely separate for that. And then we're going to also talk about divorce situations that is in this presentation. We briefly talked about that a little bit earlier. Now, people still need to qualify with income, credit, and assets. It's specific to each servicer. So that's why every transaction is different. Steve, what do you see on that front when you see these assumptions come in of people either qualifying or anything to do with that?
As a practical matter, there are obviously differences in the rate and so forth, but I don't think in practice it is all that different than, really any different than qualifying for any normal mortgage. So the buyer still has to go through the same process of applying to the servicer and qualifying for them. In short, the lender is looking to see if they would have made that same loan to that new buyer. If they would have made the same loan to the new buyer, and if there's a second or however that's incorporated, if they would have made that loan directly, then the buyer is going to get approved. As everyone knows, different lenders have different requirements. Some lenders are more flexible or easier than others, but it's the exact same requirements as if your buyer was applying. So you're not going to get someone in who was going to have challenges getting a mortgage originally. This is not going to be a great option for you. But if your original buyer, whether they're presumed, put aside whether they're military or not, if they would have qualified for the VA loan originally, they should be able to qualify without any difference for this particular, for the VA assumption.
Perfect.
And I see a quick question that came in just saying, referring to the servicer. The servicer, of course, is the party that is, that you're interacting with when you put the loan together. So it's the party that's sending you the mortgage statements and so forth. So same thing, whatever it was, if you applied for a mortgage with them for a VA loan, if they would approve you, you should be approved. If they would approve you for the original VA loan or a VA loan today, or whatever the interest rate you're assuming is, then they should approve you for the assumption without any additional requirements.
Perfect. Thank you, Steve. And just to kind of also go back on one of the questions, all VA loans are assumable. I know someone asked, can an LLC assume a VA home loan? To my knowledge, there's no restriction on that. It's up to the servicer, and if the veteran wants to keep their property locked in. Someone mentioned, like, do they have a seller that is willing to give to a non-military member because their property is not selling? And someone also did mention that they bought 2 properties subject to existing VA loans, and they did not have to credit qualify. This is why what we're talking about today is more of like a general of like, hey, understanding what that product looks like, and then tools on how to ask the right questions of the servicer, because you want to be able to jump on that call with the service member to make sure you understand that what you want to do is possible, because everyone's going to have different requirements. That's what makes this section difficult. Now, the veteran can do a VA appeal or a special appeal, which we're going to talk about here shortly. The additional requirements to do a VA assumption is a loan must be current or brought current at the time of closing. Prospective purchaser has to be credit worthy, right? So credit collateral capacity. The prospective buyer has agreed to assume all the loan obligations, including the obligation to indemnify VA if a claim is to be paid out. And one of the questions that came up as well is that the buyers do not have the option of using their own lender. They have to use the servicer that services that mortgage in order to qualify. Question came in is, can the buyer bring it current? Steve, do you know if that's possible?
So understand the underwriting process itself. When you were qualifying for the loan, you have to qualify with the seller's existing mortgage company. That's what we mean by servicer. So the seller's existing mortgage company for all intents and purposes. And the loan does have to be current, but the buyer can pay the money to bring the loan current. So it just has to be, and it can be, again, be all negotiated as part of the purchase agreement or so forth, or it can be used from the seller's proceeds that the seller would ordinarily have walked away with in cash. I do want to piggyback for a moment on the seller's VA entitlement. So when a veteran has a VA entitlement, they have a right to get a VA loan. And the biggest advantage to that VA loan is that they get to borrow at a relatively high loan to value ratio at what is often a below market rate. But there are many times where a veteran would, so if the veteran sells their property with the VA loan, they leave it in place, the buyer assumes, and the buyer is military, or the buyer has their own VA benefits, then the buyer is just going to use their own VA benefits to assume. But if the seller's selling it to somebody who is not eligible for VA benefits, the buyer can take over the seller's VA benefits. So the buyer does not have to have their own benefits. They can take over the seller's. It's just that when they do that, the seller's VA benefit is used, limiting or preventing the seller from being able to take a new VA loan. Now, David suggested that, why would the seller want to do that? Well, there's a couple good reasons why the seller would want it. One of them is it's a difficult market and they're having a hard time selling. Another one is the rate that that the buyer would be able to assume their loan is so advantageous that they can sell their property at greater than market value. If the buyer can take over a loan at a 2.5, a 2.875% interest, people live in a monthly payment world. They may be willing to pay $750,000 for a property that would only be worth $700,000. Or they may be willing to pay the seller a higher interest rate on a gap of, if the seller carried back some financing, they may be willing to pay a higher interest rate on that one. Or certainly if you have two houses that are directly next to each other, they're selling at the same price or very close to the same price. One, you get to assume the loan, the other, you get the market rate. The one where you get to assume the loan will sell faster and for more money. And of course, I point out the biggest advantage of the VA loan is that the seller gets to, is that you get to put down less money on it at a very attractive interest rate. Well, if you've sold your property for more than market value, you may have plenty of money to put down on your next house, and that may not be as big a concern, or you may be able to benefit otherwise. So we do see a lot of them done to non-military people, but it has to make sense. I think the environment we're in right now, where you can assume a loan in the 2s or even in the low 3s, in comparison to 6%, 7%, this is a very attractive environment.
Perfect. Thank you, Steve. Couple of questions. So if someone defaults on the mortgage, it just depends on how the entitlement, how the loan is set up, which we're going to cover here in the next slide. And so just to confirm, the buyer can bring the mortgage current for those purposes.
Give me 1 sec, David. So just the point there. So when you sign the paperwork, one of the things you're signing releases the seller of personal liability. It makes the buyer liable for that loan. So if the new buyer should not make the payments, it does not affect the seller from a credit perspective or anything else. That it affects only the buyer. And that is a large amount of the paperwork you were executing at this.
But Steve, is that also for non-military members? Because
Yes.
It does. Okay.
Yeah, yes. As to the credits and so forth, it affects only the buyer. That's why there's.
Perfect. Thank you, Steve. Now, when it comes to the actual VA funding fee, the VA funding fee is 50 basis points, so 0.5%. And that's something that unless they have a service connection disability, then there's no funding fee. Now that funding fee cannot be rolled into the mortgage. It has to be paid up front, which is very different than a regular purchase transaction, because again, it's rolled into the mortgage. In this scenario, it cannot be rolled into the mortgage itself. Lenders that have automatic authority, right? Lender controls the approval process. And like a lot of people have mentioned that when they do these assumptions, they're about like 3 months to do. And that's because of how many people want to do them. And they didn't have the infrastructure in place, because why would you assume a mortgage, right? They probably just did a handful of them. Now they're looking at doing hundreds, if not thousands of these. So this is why you have a much longer delay in current times, right? But still, typically it's going to be, if things get back to normal, 30 days. Otherwise, the loan actually has to be submitted to the bank itself. The funding fee cannot be rolled into the second mortgage because it's for the purposes of the purchase itself. So they will have to come up with that money. Now, when it comes to loan fees for automatic, it's like a couple $100. Steve, you've seen these, like they're not much money because you're not paying, right? When you look at a regular VA transaction,
it's comparable or lesser than normal lender processing fees and so forth. You're not seeing anything different on the lender's portion of the CD than you would. In fact, it's probably slightly cheaper if you're accustomed to paying a VA origination.
Right. Yeah, because they typically have 1% origination fees plus discount points. So all of that would be gone. So in theory, like you're saving a good amount of money by also doing that. Someone's asking, will non-military buyers pay the funding fee?
Whoever is the buyer, it doesn't make a difference whether they're military or not. I suppose theoretically it could be either party, but typically the buyer pays it. It's again, same thing. It's showing up on the lender side, same way you normally would have the buyers paying the fees in connection with.
Yeah, Mary, we'll find out about that. I could put that in my notes when I send you guys an email out, just kind of clarifying. if non-military, if they paid that VA funding fee or not. The one thing that people also don't realize is the escrow accounts may not revert to the current owner. So whatever is currently on the property, right, that will also directly transfer to the buyer, so they will not get that money back. Now, if a veteran has, let's say, a service-connected disability and it meets the criteria not to pay taxes, then it'll also just show a zero balance. But then the incoming person will have to set up their own escrow funds out of their own money. So you kind of have to keep that in mind, that is something that can happen. That will be an additional cost to the buyer of the property. Now, if the buyer is coming in and there's currently taxes in the property, and then they will be exempt from paying taxes, then the buyers will get the refund for the escrow that's in the current escrow account. So keep that in mind.
Yes, we just make the adjustment on the CD for any balances left in the escrow account.
Okay. And then someone said in here that yes, non-military members pay the full 50 basis points in order to take that property. So it takes a village to close a deal. And here we are. So now processing with the loan. So the people have to sign a release of liability, right? So that's what Steve was talking about. If the new owner defaults on the mortgage, it does not affect the seller. When it comes to VA appeals, that's something where sellers and buyers can do. So if they submit their information to the servicer and the servicer comes back and says, you've been denied, we cannot do that, then you can appeal that directly with the VA. Now, that goes into what I was talking about with overlays, right? There's plenty of times where even like myself, that when we're doing regular VA deals, we might come across something, because the VA itself is very loose on the requirements. And then sometimes they only have a couple sentences on, let's say, a certain subject, right? And like, for example, like self-employed, most people are like, you need 24 months. You don't. You need 12 months on a VA deal, right? The lender can have an overlay for that. If the buyer or the seller feels like they should be able to buy it, they can appeal it directly with the VA and state their case for them to overturn the servicer's decision to deny you based on whatever it is. And also point out that VA does not have a minimum credit requirement, but most lenders do. So that's just another tool, just in case you might be running into a credit score issue. You're able to do that. When it comes to special approvals for VA appeals, this is where the seller agrees to remain secondary lien holder on the loan following the assumption. So this would be, so Steve was talking about release of liability, right? New person comes in, they get released. If they default, it doesn't affect the seller. But the VA can allow where the seller agrees to remain as a liability holder for the actual assumption. I'm not sure in what cases this would work, but
sales of family members is when we usually see it. So if they're selling their property to a family member or maybe a particularly good friend, it's not a very good idea for the seller. You'd co-sign their car loan for $300,000.
Yeah, that's a good point on that, Steve. And then just someone had a question that it makes sense, right? So even when they sign that release of liability, right? Let's say I sell my loan, or I have a veteran assume my loan, or non-veteran assume my loan, and my entitlement's locked into that. Yes, I am not held liable, but my benefits of, let's say, $500,000 are tied into that property until they sell it or do whatever with it. If they default, the new buyer will be like, their mortgage will show that, hey, they've defaulted. But for me, does it lock out those benefits because they defaulted? Does that make sense?
Yeah. Maybe I didn't hear it.
Yeah. I think that's a tricky one, just because we might have to just get a follow-up clarity on that in the event that if you're released from the liability of making the mortgage payment, but your benefits are tied into that property and it does go into foreclosure, what happens with my benefits?
It doesn't make, so the benefits are only used for the period of time in which the loan is outstanding. So it doesn't matter how it gets resolved. Once the loan is no longer outstanding, the benefits are restored. I did see a question in here. Can the seller require the buyer to pay off the loan within a certain period of time? never been asked that question. I am in the back of my mind trying to figure out if there'd be a legal way to enforce it. I am not sure that there would be. It's a good question. And it is a legal one as to whether or not there's a way for the buyer to actually enforce that type of agreement. And I cannot come up with a way, but I will get back to you.
All right, perfect. And then another good question is, can a non-military buyer have a non-occupant co-borrower for qualification purposes? I love the creativity in the group. So in a regular transaction, like if someone uses a conventional loan or a conventional loan, you can't have a non-owner occupied co-borrower be on the mortgage, right? On a VA deal, you can't. So if you're a veteran and you have a non-owner occupied co-borrower or a non-military member or non-spouse, then, you have to put 12.5% down payment. Like you can do it, but it's just a process, right? That's something that you're going to have to typically, you're going to have to go to the servicer and see what they require, which we're going to talk about here in the next slide or two. So we'll kind of go through what questions you should be asking for that. If the seller is unable to otherwise continue payments on a loan, right, then they'll allow for this to happen. And like Steve mentioned, this is typically like done for family members on the transaction. Now, in a divorce situation, right? So someone asked this earlier, and this is something that, I'm honest, I learned about this recently because I dug into this and realized that you can actually do the VA assumption with a divorce, right? So this is where seeking release, and this is also all in the VA handbook, right? So seeking release from personal liability as a result of legally binding separation agreement or divorce proceedings, right? So the property has been awarded to the spouse of the property, but they are also on the mortgage themselves. If they qualify for the assumption, then there's no VA funding fee, but the same process applies, so they still have to qualify, right? Divorce has to be finalized or a signed separation agreement has to be in place. And the entire state encompassing by the VA home loan has been vested in the name of the veteran's former spouse and military member. Now, if a military member is awarded the property, and remember, it's whoever's first on the mortgage, it's their benefits that get locked in. So if you have two military, a veteran and spouse, and they're both military, whoever's first on the mortgage, it's their benefits that get locked into the property. You're not splitting benefits unless you do a joint home loan application, right? That's not how it works. It's whoever the first person is. So if the veteran that has the primary borrower with their benefits, if they win if they get awarded the property, then it's a little bit easier process because they just call the property, they just call the regional loan center that they live in. And I'll show you guys where that's at. They can call them and then seek for the ex-spouse to get a release of liability on the property, and then it would remove them off the mortgage. So it makes it also just so lucrative because you're still keeping the same rate, right? Typically, you would have to refinance out of that mortgage into a new one, take the current rate, and just kind of bite the bullet on that.
Your conventional lender will definitely not release you from the loan. It's
right.
Right. That's not going to happen.
Yeah, that's only on the VA home loan, by the way. So it's pretty nifty just to be able to know this. I mean, life events happen, and also in the military, it's about I think a little bit higher than 50% divorce rate. So like knowing some of this stuff is important as you go throughout the transaction. So someone asked, when you assume the loan, does the term reset from the date they assumed it? No. So just kind of keep that in mind. If you have a 30-year mortgage, which remember, most people that have these low rates, it's for the last like 2-3 years. That's it, right? So if you have a 30-year mortgage, but they've been paying it for 2 years, you're assuming a 28-year mortgage. It doesn't reset for another 30. It's a 28-year mortgage. Keep that in mind. Now, when it comes to working with sellers, right? You have to the sellers need to connect with the servicer to gather all the information that they need for the buyers, right? You need this step. I would highly suggest you being on that phone call with the client and the servicer so they can explain the process of approval, what the requirements are for veteran buyers, non-veteran buyers, what the second mortgage requirements are, Do they have a debt to income requirement? Do they have a residual requirement? Those are the things that you want to be able to track, right? And the time frame of the buyer approval process. A lot of agents that have done these, they say that it takes about 3 months to do. Does the seller have 3 months to do this, right? Or is this something they need to do quicker? This is why it's important to qualify both ways, right? VA assumption and just a regular VA home loan, because it just may not be able to work.
I also think, David, that I think it's a little unfair to say that it takes 3 months to do it. It does take 3 months to do it, but it takes 3 months to do it because hardly anyone has been doing them for the last decades. I think when they suddenly make a significant amount of the market share, I think we're going to see normal residential mortgage processing times.
Yeah. Once it gets ramped up. Yeah, Steve, I'm with you. I was just, noting some of the stuff that people were talking about. But yeah, so just kind of keep that in mind. And then there's no time frame for how soon someone can assume a mortgage or reassume a mortgage, right? So if I came in and assumed a mortgage today, and then I wanted to reassume it to somebody else, I can do that, right? We're not saying like this is a Ponzi scheme, like, hey, I'm going to go assume someone's mortgage and then sell the property for a higher amount because I could just resell it. But there is no time frame for that, right? And then for the veteran taking ownership of that property, it has to be a primary residence. But there's nothing like, just like a regular VA loan, if they live there for a couple months and then they end up PCSing somewhere else, they can turn that property into an investment property, right? That stands as a regular VA home loan would. Someone's asking, can the sellers advertise their VA status to attract buyers to assume a loan? Steve, can someone say like, hey, we have a VA home loan assumption?
They absolutely, they should. We should start seeing it in the MLS listings, the assumable rate and so forth. And as we say, we're stuck with the seller's lender. So on the assumption, you want to, if that's a good lender, you probably want to highlight it. If it's a lender that's slower, you may want to point that out as well. You need that second mortgage. You may want to, link up or explain briefly or include in your disclosures a thing from David and how, what the numbers look like and so forth. I think David's actually going to go over it in a second.
Yeah. So thank you for that. Yeah. If you guys have questions, please keep asking on them. Sorry, we skipped through pretty quick. All right, so now we're going to talk about the portfolio second mortgage that we were talking about. So this allows up to 95% loan to value, and you can do 100% financing with a 5% secured CD with our bank, right? So this is very specific to like what we can do. Each situation is going to be different, right? This is a portfolio product that's going to be done on a case-by-case basis. We allow up to $350,000 on a second mortgage and it's a fixed 15-year term. Okay, just want to keep that in mind. We have flexibility with the dollar amount because again, this is a portfolio product. Even like at my bank, I'm the only one that can do these. It allows veterans with reduced entitlement to use the VA home loan again, right? So this is something we talked about previously, like, hey, like if the veteran doesn't have, they might have another VA home loan. They're assuming, let's say, they have a $500,000 property. They're buying a $700,000 property now. They will now have to put a down payment to be able to acquire that property. Well, if they assume the first, they could do the second and it won't affect them. So now the loan limits for 2023 are going up almost $100,000. They're at $1,089,300 as of January 1st of 2023. The product allows, and so like when we do these, right, the product allows for veterans to be both qualified and for a second assumption, as well as a regular VA home loan purchase. The interest rate, assuming good credit, we're going to talk about that here next. So here's an example of a $700,000 purchase. Let me just get the little clicker out so you guys can see. So you have the original mortgage assumption at $500,000 on a 30-year term. Interest rates at 2.25. Total payments going to be $1,911. So like we discussed then in the previous part, it's $688,042.98, right? And again, kind of remember that all of this sits on the education purposes. We're not putting in any type of APR. It's just looking at straight math when you're doing this. when you look at the second mortgage, right, at 165,000 on a 15-year term, it's at 9.74. So basically, we look at a prime, whatever prime is at times, plus whatever the margin is for the bank at the time of the closing, right? So in this case, it's 1746.95. So total life payments is 314,450, and then we have a down payment of, let's say, 5%, or they can do like a 5% CD, totaling 700,000. So in this case alone, right, and we look at a new VA purchase, looking at where the current terms would be, you'll still be looking at about a $590,000 savings in the product itself. Now, remember, this is for education purposes. We're not putting in APR. We're not putting in the additional stuff because it's going to be a case-by-case basis for each person for that. And they also, remember, veterans have the option of being able to get a loan from a TSP, which a lot of times folks have a good amount of money in there. They're able to do that.
I want to make a couple comments on the loan, just because I've seen these done in practice. So I think a lot of us are in this world where, right, 12 months ago, interest rates were in like the 3s and the 4s, and you look at a second mortgage at 9.74, and you go, it's crazy money. But I want you to look again at the total payment. It's not. To be able to keep whatever that is, 70% roughly of the total debt at a 2 point something, and then to pay just on that small portion, whatever that is, 30% of the debt, 15% of the debt at 9.74 is saving you a significant amount of money. I think in this example, it's about $800 per month. So even the higher rate second mortgages produce a much lower monthly payment. And we need to retrain ourselves and retrain our buyers and our sellers that this is an advantageous thing. And of course, it's better than even it looks, because remember, that second mortgage is only there for 15 years. So you're saving $800 a month for the first 15 years, and then you're saving approximately $3,500 a month, sorry, $2,500 a month. But for the next 15 years afterwards. So it's, I think, a little bit of retraining and getting ourselves to appreciate it. And you may need someone qualified like David to run the actual numbers and show you what the savings are. Obviously, from the listing agent perspective, if you could link up with, if you've got a VA loan, you want to have that lender with you in advance to draw up those scenarios so you can include it in your packages. I do think the vast majority of people in this world, and have done settlements for 20 plus years, they live in a monthly payment. And it's a big difference if you are buying one house is going to cost you $44.24 a month, and the other one's going to cost you $36.58 a month. It's a very different world as to what your client can qualify for, and a very different world as to who you can sell your property to.
Yeah, thank you, Steve, for that. And someone just asked, is it variable rate? No, it's fixed rate. So it won't change for the 15 years. You'll be able to do that. Now, and then someone mentioned too, there's no prepayment penalties, so you could refinance out of these, right? It's for the purposes, because let's say you want to get like a traditional interest only second mortgage. So once you assume the first mortgage, once the transaction happens, 6 months later, you're then able to, because you need typically have 6 months of vesting on title in order to be able to refi, so you'll be able to refinance and do whatever you want with that second, or pay it off, whatever the case may be. Someone earlier had a question about gift funds, right? So even for our case, so we could take we could do a 5% gift fund, right? But again, it's going to be subject to, and then also for the assumption itself, if the servicer allows for gift funds to cover the difference, they can do that. And there's actually, the VA allows for that as well, right? So if a family member wants to give them a 10% or 20% down payment, they can do that. We see that all the time. So just kind of keep that in mind for these purposes. And then again, we'll be sharing this slide with everybody, so you'll have that. And someone also made a good note. Now, we talked about you can advertise these as second mortgages, but I don't know if there's any type of disclosure you have to say, because you're letting people know what someone's financing terms might be. So just get with your brokers on that to be able to do that. All right. Here's some resources that I provided. So regional loan centers are here. The first one is to be able to contact the regional loan center. Now, all you guys are in the Roanoke. If you're in the DC, Maryland, Virginia area, you're in the Roanoke area. If you have questions, you can literally pick up the phone, call them, and talk with their processing team. you know, the VA has its ups and downs, but the actual regional loan center has been phenomenal to deal with. Like anytime we have questions, we can do them. In the VA handbook, this will let you download the entire book. It's like 616 pages. You can search, just type in search VA assumption. It's chapter 5. It's the last chapter. And it'll walk you through all the requirements that the VA has, right? That's what we went through today, just in a video format. And I just included my channel on YouTube. And then also I did an update for NAR because I'm a national instructor for the MRP course, just so you guys will have that. But again, we will send out a link with the video. We will send out all the slides and then all our contact information. And, you know, we're happy to connect with everybody and answer any questions that you may have. So again, here's all our contact information. Let me just double check to see if there's any questions in here that we didn't answer. And so once you own that property, I mean, if rates were to go lower than 2.25, you can refinance that, right? You are now the owner of that loan, so you can do whatever you want with it. So I'll stop sharing the video and see if you guys have any questions. Let me see if I can just open it up for everyone.
As far as the marketing, you know, of the seller's balance on their loan and so forth, I suspect that, again, if you were marketing it as a sales tool, you know, the seller would probably want to consent to that. I think that's probably in the standard disclosures in most places, whether or not you could disclose the balance on their loan. And again, you can use approximate numbers and so forth. But this is something that's going to sell their house faster, sell it for greater value. It's going to be worth it for most sellers to want their loan to be assumed. And David, to give the last example of when it would be advantageous for a veteran to want to give up their VA eligibility, if they're married to another veteran who also has VA eligibility, they don't need two of them at the same time. So that would sort of be a no-brainer, and that's fairly common in the military.
Yeah, and then that is pretty common. I think people think like it's not, but it is. We come across that all the time. So it's just more tools to put in your tool bag. And like I said, we'll send out an email with all the video itself once it finishes downloading and adjusting, and then we'll be able to do it from there. So someone had a question, like if the balance on the current mortgage is $100,000, but the place is what, $500,000, at that point it might be diminishing return, right? Like it may not be worth it.
It's not going to be worth it unless the buyer was otherwise going to take $100,000 mortgage.
Yeah, that wouldn't make sense.
Again, sweet spot right now, like next 2 to 7 years, like that's when the numbers are going to make a whole lot of sense.
Yeah, no, and that's good. And this is why we give you guys that example. And we're also happy to, I mean, you can just create an Excel sheet. And so when you look at these, you can just, and I can put one together also and send it out to you guys where you can put in, you know, someone's current situation, but you would have to kind of know all the numbers for a specific buyer to be able to run that, right? This is why we mentioned when we do qualify someone for the assumption loan, we also qualify them for a regular loan at the same time, so they can see how both will play out, right? Because if a servicer won't allow them to assume it, remember, you could be disqualified to assume it, but you could be qualified to buy it at 100% financing. It's kind of a crazy situation. It's kind of a crazy scenario, but that's just how it works. They'll be able to be qualified for both, be able to execute and see the differences on that. Someone had a good question. Someone just kind of had a question on if the seller is in default on their property and they want to offer an assumable mortgage to a buyer, the buyer can pay the difference in the assumption loan. Let me just see that. I would say, I mean, I'm not sure. I would need a little bit more clarity on that.
Yeah, I'm not entirely sure I understand the question, but if the question is if the seller's in default, can the buyer agree to what I'm going to interpret it as, can the buyer agree to a purchase? Can the buyer agree to assume the loan, pay all the closing costs, and bring the loan current as part of the settlement? Yes, absolutely, that works.
That's awesome. Yeah, no, that's invaluable information. Hopefully you guys, anything else you guys have? The minimum loan amount, that's a great question. I will get back to you guys on that as well. We just got that approved on Monday. So yeah, we'll look at what the minimum amount is going to make sense, because you have to also remember on the second mortgage itself, we have to get the current servicer has to do a subordination agreement with, right? We're going to subordinate to the first mortgage. So we'll take a look at that, and I'll let you guys know. I'll send you a little bit better details on that.
In the 1980s, when these were last popular, when the seconds were extremely small, a lot of times the agents would carry the seconds themselves.
Oh, really?
The rates were very attractive, oftentimes if they were particularly small. There were a lot of agents out there, particularly from the early 80s, that were in many cases, and it helped during downtimes if you had, $100,000 of mortgages coming in, they used to be higher, but at 18% and stuff of that nature, you got money coming.
Perfect. Thank you. Someone else had a question about what are guidelines and assumptions on as second homes. So if you're using the VA home loan, no. I mean, yeah, if you're using as a VA home, if you're doing we talked about substitution of entitlement, it has to be a primary residence. Okay. If it's a non-military member, they can buy it as either one. Now, there is no set guidelines. This is the crazy thing. There's no set guidelines for non-military members. So that's why you have to talk with the servicer to determine what that looks like, right? This is why you have to connect with them. They have debt to income requirements. Do they have credit? Someone was saying like, hey, I bought 2 homes and I didn't even have to get credit qualified. Yep. Someone mentioned in here that if a military member assumes a VA loan and submits to transfer his or her VA entitlement, the buyer must occupy the property within 60 days, as if they would on a new VA purchase. So a caveat to that, right? I just want to, just because I teach this stuff and I know the VA handbook. So if somebody buys a property and they assume it, they technically do not have to move into that property within 60 days. We run into that all the time when I have clients, and let's say we had a recent closing in Hawaii. They were going to move there for another 6 months, but the VA allowed them to be able to buy it and not live in it. And also remember, veterans do not have to live in a property if their dependent lives in that property, right? We come across that as well all the time, and that's something the VA does allow, right? So I had recently had someone in stationed in Georgia at Benning, where I originally went for my MLS school. And then their spouse was moving to Chicago to be in medicine, right? They got into a university. So they were able to buy a home in Chicago using the VA benefits, and the veteran didn't have to live in there. So keep that in mind. There's different guidelines to all of that. And then same thing's going to go with non-military members. That might be a little bit different with when they would have to assume that property. So.
As far as when the listing agent should get involved with the, well, obviously in the beginning, right? The listing agent, if they're doing a great job, is going to find out whether it's a VA loan, find out the details of it, check with the servicer. Then they're going to sort of advertise in broad general strokes when they're listing the property. Then if the buyer's interested in assuming it, then the buyer is going to have to reach out to the lender. If the selling agent wishes to be involved in that process, they're definitely going to need a written authorization from the seller so they can get involved and so forth. So it's a little more cumbersome in the beginning because you got to start with the listing agent and the seller contacting their mortgage company, and then it's going to be the buyer and the selling agent right after it goes under contract. Same way they would normally apply.
Yeah, and one thing I would add to that is that I would have a client be qualified both ways. I would have someone. Well, I mean, you want them qualified regardless to be able to assume the entire mortgage with new terms, right? You still want to have someone that's going to be credit worthy and still be able to be able to close on that transaction. I mean, I don't know how you guys feel about that, but at least because if you don't look at properties without a pre-approval, right? Like if you just had a veteran come in and say, hey, I just want to look at assumed properties, you're not really sure where they stand on their qualification.
They owe more on their mortgage, the same problem is unless the buyer's willing to pay more for it. But again, assuming a mortgage, even at over market value, the payment is way lower, may make sense for the buyer.
Someone had a question if the seller owes more than they purchased, so like they're upside down. So if, let's say, assumption is 800,000 and the property is only worth 700,000.
That, again, it depends on the mortgage rate. They're at 2.25%. That monthly payment is probably lower than, yeah, I'm sure it's lower than 700,000 at 6.5%. In fact, it's probably,
Yeah, it is. Yeah, they would save a ton of money on that. Yeah, so some of these situations, like when I talked to the VA again this morning, they're gonna want you to like anything really specific. You need to submit to the VA, and the manager will review it, and they get back to you actually pretty quick. Someone's asking.
No appraisal necessary on an assumption.
Yep, no appraisal or termite inspection required. As a listing agent, is there anything that she, and seller can do prior to going active to help the process? Yep, so that's what we talked about, is you have to contact the servicer. I would be, as a listing agent, have you be on there and ask all the relevant questions. What are the requirements for mill to mill, right? So someone doing a substitution of entitlement. And then just ask your sellers, like, do you want to tie your benefits up? And if they don't, then it's not even worth going down that avenue. And that's something you can let people know up front, because I'm sure people look at these like, oh, I want to assume that mortgage, and they can't. Now, a caveat is that FHA loans are also assumable, and they do have different requirements on those, and anyone can assume those. So keep that in mind.
And those are the only two loans that are assumed in the United States.
Yeah, those are the only two loans that are assumable. So we'll do a presentation on FHA loans as well, because they're actually, people are like, well, they have private mortgage insurance, but man, you get that 2.25% interest rate, you can still do a lot with that. Let's say, who would typically initiate the conversation about Assumable? It's the listing agent would ask. Now, I don't know. Steve, is it public information on who has a VA loan and who doesn't?
Yes.
Okay. Yeah. And then someone also mentioned, sorry, USDA loans are also assumable. We just haven't done too many of those, but yes,
there's a couple.
I like the technicality of the group.
Yes.
Yeah,
USDA
yeah, there's not
if you are doing a second, you absolutely do need an appraisal on if there's a second mortgage, they do.
Yeah, there's no limit on like you can own it. You can be in the property for 2 days and have it assumed by someone else. There's no time limit on those.
It's just, again, if it gets to be too far, right? If you're assuming a loan someone took 20 years ago, the outstanding balance they have on the loan is probably not something that is worth it to the buyer to assume, because the balance is too
low. Has anyone gotten closing costs for a VA assumption? Yeah, well, it's still a regular purchase, right? So if you're purchasing it for 700,000 and you negotiate a $10,000 credit in there, well, the seller's just paying you that. Or if you do like a second mortgage with that, then it's going to be total LTVs based on a total purchase price, as long as it could be appraised.
The closing costs are almost identical as if you had financing on the property. The only variable whatsoever is you were paying the 0.5% origination fee for the assumption, which if you're otherwise doing conventional financing with no origination fee, then it's slightly higher. If you're otherwise doing a VA or FHA or some other loan with an origination fee, it's going to be slightly lower. Completely comparable across.
Yeah, so good on that. Yeah, so Karen just reiterated what I said, that 60-day, it's very dependent on the client's financial situation, or like their situation. So keep that in mind. Remember, funding fee does have to be paid up front, as we talked about, and it cannot be rolled into the mortgage itself. Closing costs are going to vary, but remember, you still have to pay title fees, transfer taxes. You're not going to be paying origination fees. Like a typical VA loan has some type of origination fee and discount points that wouldn't be applied in this situation. So really look at the closing costs. Someone might have mentioned that they seem high, but again, every jurisdiction is different, right? Transfer taxes could be high in some areas and not in others.
Also, I won't name them, the particular lender that was named before, though, also has the tendency to just quote high fees, quoting all the buyer and the seller for disclosure protection purposes, it shouldn't make any difference to the
Right.
the lenders.
Yeah.
The fees are regulated by VA.
Yeah, they're setting them, and then the rest of it, like I said, is done. You can get a seller credit because it can be just done as a regular transaction. But yeah. And
David, what do the fees look like? What do the fees look like on the second mortgage?
So the second mortgage, it's gonna depend, but it's gonna be about 2 discount points for the mortgage itself.
And the rate on that you said was the 9.7, and again, right, all variable. Based
That's
on
just
how much they're
right.
putting down and so forth. But for a ballpark rate, that's where it is today. As prime rate is fixed, as prime rate goes up, obviously that will jump up. As prime rate drops.
No, it's fixed. So it's
but where it is today.
yeah.
So it's a fixed rate product is what your bank is offering.
But it's based
But
on today's prime plus
where that rate is fixed is following generally the same as mortgage rates go up, it goes up. As mortgage rates go down, it goes down.
Yep. But that's at the time that you lock the deal in, right? Yeah. So yeah, it's subject to that. And also remember, the second holder has to also be able to say, yes, you can do it. But that's why we always do, like, moving forward, that's what we're going to be doing for everyone. Is anyone that be pre-qualified, it's going to be pre-qualified both ways. What the max is doing an assumption loan, and what the max is if they just did a regular VA loan, because that can also have a huge impact on that. Someone's asking about the Excel sheet. Can it compare a VA assumption with the second versus one without? Yeah, we can definitely do that. But just remember, each client's situation is going to be different, buyer and seller. So in order for you to get accurate information, they have to be qualified for that second as well, right? So just keep that in mind. Yeah. So like Karen, someone mentioned that all VA loans are assumable. You can search to see if the person has a VA home loan on the property. Just because remember, just because a veteran is a veteran, they might not have a VA home loan on their property. And then we'll be able to include some numbers on an Excel sheet. So we'll send that out in the next couple of days, just because we have to edit the video, post it, and then also just create the Excel sheets and send it out.